All right, let's jump right in. If you're involved in the world of crypto, you need to know about a massive change that's coming to your 2026 self-assessment. To make sure you're ready, we've teamed up with the experts over at My Tax Accountant to break down exactly what's happening and, more importantly, what you need to do about it.
For a long time, the crypto world felt a bit like the Wild West, right? A lot of people assumed their trades were basically invisible. Well, I'm here to tell you that era is officially over. Starting in 2026, HMRC is getting what you could call a direct key to your digital life.
So here's what we're going to cover to get you fully up to speed. First, we'll dive into the huge tax shakeup itself. Then we'll look at HMRC's powerful new all-seeing eye. We'll cover the common traps people fall into and the very real penalties. And then, the most important part, we'll give you a practical checklist and show you exactly how to get your affairs in perfect order.
Okay, let's get straight to the heart of it. This isn't just some minor tweak to the tax rules, it's a fundamental shift in how things are done. The days of crypto tax being a sort of voluntary, often forgotten affair, they're gone.
So what's driving all this? Well, it's a new global agreement called the Crypto Asset Reporting Framework, or CARF for short. What this means in plain English is that countries all over the world are working together to end tax secrecy for crypto. Exchanges, wallet providers, it doesn't matter where they're based. They will now have to automatically collect your data and report it straight to HMRC. The bottom line? That idea of hiding trades on a foreign exchange? Yeah, that's not going to work anymore.
And you need to know this is happening much sooner than you probably think. From the very first day of 2026, January 1st, these platforms are legally required to start collecting your data. That gives you the rest of that year to get your house in order, because come 2027, all of that information from 2026 gets handed straight over to HMRC. The clock is definitely ticking.
Let's just be clear about how massive this change is. In the old days, it was all on you. You had to voluntarily declare everything. And frankly, HMRC had a pretty limited view of what was really going on. But now, it's completely automatic. They get a direct data feed from the exchanges, and their computers will automatically match it to your tax return. If the numbers don't line up, you're going to get flagged. It's as simple as that. So the rules are changing, that's one thing. But that's only half the story. The other, and maybe more important part, is how HMRC is going to use this flood of new data. And trust me, they have some incredibly powerful tools ready and waiting.
You're looking at something called Connect. Think of it as HMRC's AI super detective. It's designed to pull in data from everywhere. Your bank accounts, credit cards, land registry, even your social media profiles. It then cross-references all of that with the new crypto data to build a complete 360-degree picture of you. Basically, their goal is to know your financial life better than you do.
And we're not talking about vague summaries here. The level of detail the exchanges will be reporting is, well, it's everything. Your full legal name, address, date of birth, your national insurance number, and then a complete breakdown of every single trade, what you bought or sold, its value in pounds, whether it was a buy, sell, or swap, and the exact number of units. They'll practically have a copy of your trading ledger.
Okay, so now we know what they know. Let's talk about the consequences. Because getting this wrong, even if it's an honest mistake, carries a much, much bigger risk now. And honestly, this is where so many people trip up.
This is the million-dollar question, isn't it? And it's where a ton of confusion comes from. A lot of people still think you only owe tax when you sell your crypto and cash out into pounds. That is a really, really dangerous misunderstanding. You see, there are two main types of tax you've got to have on your radar. First, there's capital gains tax. This gets triggered whenever you dispose of an asset. That means selling it for cash, sure, but it also includes swapping one crypto for another, or even gifting it to someone. Then you have income tax. This applies if you get paid for work in crypto, or if you earn rewards from things like mining, staking, or even getting an airdrop. Imagine you're a freelance graphic designer in London and a client pays your invoice in Ethereum. That's income, and it has to be declared just like any other payment.
So what kind of numbers are we talking about? Well, for the 2025/26 tax year, if you're a basic rate taxpayer, the capital gains tax on your crypto profits is 18%. If you're a higher rate taxpayer, that jumps up to 24%. These are not small numbers, and believe me, they can add up incredibly fast if you've had a few good trades.
So you see this number, £300. What's that about? Well, that is the penalty HMRC can hit the crypto platforms with for every single user report that's inaccurate or incomplete. And what does that mean for you? It means the exchanges have a huge financial incentive to make sure the data they hold on you is perfect. They're going to be very strict because they sure don't want to be paying those fines.
Now stay with me because this next point is really important. How long can this come back to bite you? Well, it depends. If you make an honest mistake, HMRC can look back 4 years. If they decide it was carelessness, that window opens up to 6 years. But, and this is the big one, if they believe it was deliberate tax evasion, they can investigate the last 20 years of your financial life. Just think about that. A mistake today could trigger a massive audit in the year 2046.
Okay, I know that's a lot to take in, and it can all sound a bit daunting. But now we're going to shift gears to the most important part, the solution. It's time to stop worrying and start being proactive. Let's look at exactly how you can get this right and get some peace of mind.
Here it is, your simple 5-step checklist to becoming bulletproof. 1. Gather all your transaction records. I mean everything from every exchange and wallet you've ever used. 2. Go through and identify every single taxable event, every sale, every swap, every bit of income. 3. Calculate all your gains and losses for the full tax year. 4. Report those figures accurately on your self-assessment return. And 5. Keep perfect digital records of everything for at least 6 years. Do these 5 things, and you'll be in a great position.
And here is a brilliant pro tip, straight from the team at My Tax Accountant. When you're claiming expenses, never use nice round numbers. Claiming, say, £500 for a new laptop looks like a guess to a tax inspector. But claiming the exact amount, £487.55, sends a powerful signal. It says, I have the receipt, I'm organized, and my records are accurate. It's a small detail that makes a big difference.
Because that really leads to a bigger point. While having great records is absolutely vital, the ultimate protection is getting expert guidance. As the folks at My Tax Accountant put it, a great accountant doesn't just fill in the forms, they make sure you are 100% compliant while also ensuring you claim every single legitimate deduction you are entitled to. And that brings us to our final section. If you've listened to all this and want to navigate these changes with total confidence, making sure you're in the absolute best position, it might be time to think about professional help. The experts at My Tax Accountant, who helped us develop this entire breakdown, specialize in this area. They are ready to guide you through everything we've discussed today. For advice that's tailored specifically to your situation, whether it's crypto tax or any other self-assessment needs, you can give them a call on 0208-570-8531 or send an email to info@mytaxaccountant.co.uk.
And now for a very quick but very important note. Please remember, the information we've shared here is for general guidance only. It's not a substitute for professional, one-to-one advice, and you absolutely shouldn't rely on it exclusively when making financial decisions.
Because to get advice that is truly tailored to your specific circumstances, you have to speak with a qualified professional. So the question I want to leave you with is this. Are your crypto assets and your tax affairs ready for the new reality of 2026?
Thanks so much for your time today. For more essential updates just like this one, make sure you hit that subscribe button on the My Tax Accountant channel.